This is the agenda for today. I'm going to spend some time discussing the changes in the area of corporations and pass-through entities. We also will be discussing international taxation changes, individual and wealth transfer provisions, as well as SALT implications from all of these changes. Again, I'd encourage you, if you have questions as we go through the presentation, please feel free to post those, and we will do our best to address them at the end of the session. These are our presenters, myself, Alan O., Andrew, and William will be presenting on international tax issues. Alan H. will be presenting on individual and wealth transfer provisions, and Tony will be discussing the SALT tax implications. My area, corporations and pass-through entities. It's interesting. I was actually around when the '86 Reform Act was passed. I was hoping I'd get through my career without having to deal with another major one, but I guess I didn't quite make it. But in any event, it was interesting. The '86 Act, a lot of discussion. The process took quite a while. Significant changes, obviously, like this one. But things, it took a while to get through the process. This change, I think, moved very quickly. Things were changing almost daily, I think, as we went through November and December. And by the time the act was passed, I'm not sure any of us really had a lot of time to absorb everything that was happening. So things moved quickly. I think as a result, certainly some of the provisions aren't as clear as one would hope. I think there needs to be and will be lots of guidance from the IRS on this. I think there'll be a need for it. Could be some need for technical corrections. So there's a lot here, and I think there's a lot of planning and opportunity that needs to take place with regard to all of this. I guess the good news is, as we go into our 2017 tax return busy season, almost all of these provisions aren't effective until 2018 or later. There are a couple exceptions, but just a couple. So at least it won't impact our filing of tax returns this busy season. Next slide. Okay, nope, this slide's good. First, I'd like to talk about some of the provisions with regard to flow-through provisions in C corporations. I've summarized here what we think are some of the more significant changes in the areas where there's significant changes. And I'll go through these in more detail. I think the first item, the 20% pass-through deduction for flow-throughs, in my opinion, that may be among the more complex provisions in the law. There's a lot there. I think how you interpret everything certainly is open for discussion. I think that's an area where we'll need to see some guidance. Corporate AMT, that's easy. It's repealed. What is interesting is when you look at the changes in the C corporation area, those changes are permanent. The changes in some of the pass-through provisions in the individual provisions are sunsetted. Next slide, please. The qualified business income deduction. This is an area, as I said, I think will require a lot of discussion, a lot of planning. What this provision does is it provides a new deduction, a 20% deduction that flows through to the business owners, whether they're S Corp shareholders, whether they're partners. it even applies to self-employed individuals filing Schedule Cs. The deduction is a deduction from taxable income, which will require a new line in Form 1040. It's not a deduction from gross income. The calculation itself is or can be complex. I do have a couple examples at the back of my presentation that I'll go through to explain it at a high level. But the complexity can be pretty significant depending upon particular facts of your situation. One of the questions that's come up is in the area of rentals, whether this deduction will qualify. Again, the key issue here is whether that activity is in the nature of a trade or business. If it is, we believe the rental will qualify. Certainly a situation like a triple net lease where there's really no activity at all, that we don't believe would qualify. It's income is only trade or business income that qualifies for the deduction. So investment type income, capital gain, interest, dividends does not qualify for the deduction, nor do wages. There are certain businesses that are specifically excluded from the benefit, and those are businesses in the fields of health, law, accounting, actuarial science, performing arts, as you see noted here in this bullet. It's interesting, it could be broader than that depending on further guidance, because it does mention services not necessarily being qualified for the benefit. And the other important note is all of this expires for tax years beginning after 12/31/2015. Simple example here is a threshold amount of $315,000 for married taxpayers. That amount is half for single or head of households. And what this threshold does is if your income, and income, when they say income, it's income, gross income, it's your wages, it's your investment income, it's your business income. If that income totals less than $315,000 for a married taxpayer, then that taxpayer would qualify to claim the 20% deduction on qualified trade or business income, S corp, pass-through income, partnership income. So even if you are an individual who is employed in one of the specified services, such as accounting. In addition, the calculation is simplified in that you do not have to take into consideration limitations imposed by W-2 wages. And again, this limitation applies at the shareholder and partner level, at the individual tax return level. Next slide, please. This is an example. In this particular case, obviously the person would not meet the threshold exception. The calculation here, the qualified business income, and let's say that's the pass-through income from an S corporation, is $1 million. There's a limitation that applies. First off, you look at the deduction. You get a 20% deduction on that qualified business income. There is a limitation that is applied, and that limitation states that your deduction is limited to 50% of the W-2 income being generated by that entity. In this particular case, 50% of $800,000 is $400,000, and because the $200,000 is less than 400, the individual would be entitled to a $200,000 deduction. Next slide. Okay. Other provisions in this change. One question that comes up is if the S Corp is terminated, there is a provision that within 2 years after the date of enactment, which is December 22nd of 17, the S Corp, which if it's terminated then becomes, for example, a C Corp, it is entitled to take out distributions from that former S corporation. The old law provided a 1-year provision where you could take out all your accumulated S corp earnings. This provision is a little bit different. This provision states that if you take the distribution, there needs to be a pro rata allocation of the S corp accumulated earnings and whatever C corp earnings and profits that are in existence at that time. Another helpful provision in the law change is the provisions of partnership technical terminations have been repealed. That is where you had a 50% change in ownership. Oftentimes you'd find situations where that could sneak up on you and you'd have a technical termination, not realize it, and you'd have some issues with that. So that provision is no longer in place. C corporation items, again, the AMT is repealed for years beginning after 12/31/17. For those corporations that paid AMT in prior years, there is a provision to allow for the carry forward of minimum tax credits to offset regular tax. So you should watch for that. And all corporate tax rates are reduced to a flat 21%. There are no graduated rates like there were in the prior law. It's a flat 21%. And the act does result in the reduction of the dividend received deduction. For example, if a dividend was subject to the 80% DRD, it's now been reduced to 65. The 70% DRD has been reduced to 50%. The other issue to keep in mind, and I think if you're a C corporation, I suspect you're already well aware of this, because this law was enacted in 2017, when you go through your financial statement process, the deferred tax items need to be remeasured based upon the 21% rate. So that's certainly going to have some financial statement impact on a lot of C corporations, both beneficial and not beneficial. Another nice change in the new law was in the area of accounting methods. Prior law, the flexibility really applied more at the $5 million to $10 million range. So once you got above $10 million, a lot of this flexibility was no longer there. What this new law has done is it's increased that $10 million average gross receipt number to $25 million. So this really gives companies the opportunity to look back at their accounting methods and determine whether there might be a more favorable way of tax reporting for your company. And again, this would apply to both C corporations and pass-through entities. So, whether you can be on the cash method, how you account for inventory, being exempt from UNICAP, all of these items are back in play if your average gross receipts are less than $25 million. We believe, these methods, it's an automatic change, require a 3115 filing, but not subject to significant costs that you would see with a not automatic change. Another significant change is in the area of fixed assets, depreciation, Section 179 expense election. Um, in the area of 100% expensing election, this is one of the provisions that does look back into 2017. So it is something you may want to take a look at for purposes of preparing the 2017 returns. The nice provision in the law here is the prior law required original use, meaning it had to be new property to qualify for bonus. That's no longer the case. In addition, it also has expanded the types of property that would qualify for this bonus depreciation. So that is something you may want to take a look at. Qualified improvements, that's been given a 15-year recovery period. There's still some discussion whether that qualifies for bonus or not. You know, that's something just, if you have that situation, keep an eye out on. The next provision, and it can be a significant provision. There's a new 163J provision in the law. The old provision's been repealed. That was the old earnings stripping rules. It's been replaced by a new 163J, which provides that in some cases there could be a limitation on your ability to currently deduct interest. Again, businesses less than 25 million in average receipts are exempt. And to the extent there's a disallowance, it is just carried forward indefinitely. We'll walk through an example of this to show you how it works. Adjusted taxable income does not include NOL, the deduction itself, in depreciation, amortization, and depletion. So it starts at EBITDA, and you go from there. There is, for real property trades or businesses, because they tend to be or have a significant amount of debt, there is an ability for those businesses to elect out of these provisions. But if they make that election, they're limited in what they can do as far as depreciation methods. They have to use the ADS method. They can't use bonus, for example. And then there's certain entities, public utilities and electric co-ops it doesn't apply to. Other provisions, net operating losses, the two-year carryback provision is gone. Now carry forwards are unlimited in carry forward period. An important provision here is the NOL deduction now is limited to 80% of taxable income. So it's almost, I view this almost as a back-end way of replacing the AMT. But it does provide that going forward, if the company is profitable, they're limited on the use of the NOL. Another important provision is the production deduction has been repealed. The next item, this item's not effective until I believe years beginning after 2021. The prior law allowed you to either expense or capitalize R&E expenditures. This change requires that the R&E expenditures are capitalized and amortized over a 5-year period, again, beginning after tax years after 2021. The like-kind exchanges of real property still remain, but like-kind provisions for personal property have been repealed. Last slide here, meals and entertainment, those have been 100% disallowance. Many companies that could have a pretty significant impact, and the 50% disallowance is expanded to certain meals beyond where it has in the past. Self-created property, you don't have the ability to generate ordinary income for self-created capital, what used to be capital assets. That's now ordinary income. And just to mention that if you happen to have a family leave policy, there is a provision in new law that allows for a tax credit depending upon certain requirements. I'll go through this quickly. Again, example of a flow-through business example, comparing prior law to the new law. Under the prior law, what we would have here is taxable income of $500,000. And again, looking at this from the individual's level, that individual would have been paid $143,231 on that income. And that presumes a married filing joint. With the Tax Reform Act, as you can see, there's further adjustments that need to be made. In this particular situation, the interest expense is limited because you need to look at the taxable income plus the amount of interest expense. I'm sorry, the taxable income plus the amount of depreciation expense. It comes to $1.4 million. $1.4 million times 30% is $420,000. That's the amount you're allowed to deduct for interest. So you get effectively suspended $80,000. Your qualified business deduction would be 20% of your taxable income of $580,000, which is the 116, and then just doing the calculation based on the new tax rates, your tax is approximately $112,000. So you save around $31,000 under the new law. And just finally, an example of the C Corp provisions. Under the old law, without limitation of interest expense, and at a rate of 34%, you'd have $170,000. Again, even with the limitation on the interest expense, because of the reduced rate to 21%, you have a tax savings of about $48,000, old law versus new law.